how do bond yields influence gold prices? Or what is the relationship between gold and bond yields? Well, in order to answer this question, we need to talk about government bonds first, what they are. So, a government bond is a type of investment where you loan money to the government for a fixed period, and the yield, in the phrase bond yields, relates to the return on the capital you invested in the bond. Bonds historically represent a port of call for investors fleeing risky assets in times of market turbulence. So it's considered to be a safe haven by many investors. Government bonds are called treasuries in the US and gilts in the UK. Government bonds, they're considered low risk compared to other assets like stocks, as the returns are guaranteed by the government. However, this is one of the reasons why I consider government bonds to be quasi safe haven and not a pure safe haven asset like gold. And it's because the returns are not as guaranteed as people think. The reason for this is because governments can have solvency issues, and if a government has solvency issues, they'll be unable to pay the interest payments to the bond investors. So as a result of that, the guarantee that people talk about in terms of returns is actually not that guaranteed. Investors, they buy bonds mainly because they provide a predictable, safe income stream during market turbulence, as mentioned before. But the other reason is that a lot of investors say that government bonds, they are a better safe haven asset than gold, because gold is a non-yielding asset, whereas government bonds are yielding. They do provide you with income, with passive income, and gold does not. So that's why they think government bonds are better. The most distinguishing characteristic of bond yields is that bond yields are inversely related to bond prices. Basically, as bond price falls, bond yield increases, and vice versa. When bond prices increase, bond yield decreases. So in knowing this, how are gold prices affected? So in theory, when the price of the bond is very low and it has a very high yield, that makes bonds really attractive for investors. They want to take advantage of that high yield, and as a result, the price of gold falls, whereas the demand for government bonds increases, and as demand increases over time, you will see the price of the bond increase. And when the price of the bond increases, that causes the yield to decrease or even go negative. You can even have bonds with negative yields, of course, but that obviously makes bonds less attractive for investors because they don't earn as much, and that causes the price of gold to increase, and it makes gold more attractive to investors. But I'm gonna get back to this point. I'm gonna expand on that point a bit later on about why this happens. So just gonna skip that for a minute. So I'm just gonna talk about whether or not the data supports this theory. So we can see on this chart on the left, we can see that around April 1980s, we can see that the theory does not work. The theory falls apart because we see a positive relationship between gold price and bond yield. So when the bond yields are going up, the gold price is also going up. And when bond prices were falling, gold price was also falling. But then we see that the theory does work around April 2005-2006 time period. We can see a negative relationship forming between the two variables. We see that as bond yield decreases, we see gold prices increase. So there's an inconsistency, there's a issue here. So this inconsistency between these two time periods suggests to us there is something wrong, either with the theory or with the chart, the way the chart was engineered or made. Well, it's important to remember that bond yields are often quoted. The most quoted bond yields are nominal yields. And the problem with nominal yields is that they do not take into account inflation. This is the reason why we need to look at the chart on the right, where the chart actually uses real yields and correlates them to gold prices. And these charts are from Sunshine Profits, by the way. So we can see on this chart, as real bond yields decrease, we see the gold price increase. Basically, on this chart, there is a clear negative relationship. As bond yields decrease, gold price increases, and vice versa. There might be a slight inconsistency around January 2015 time period. Maybe they're following a similar trend, but overall is a quite strong negative relationship. But I want to expand a little bit more, and I want to link this chart back to this point that I made earlier. So I think what's happening here is, if the real yield of a bond is 0%, let's say, that means that the government bond has lost its safe havenness. Now, what do I mean by this? Well, gold already is non-yielding. So if the yield on a government bond is also zero, non-yielding, that is going to disincentivize investors from investing in government bonds. Why? Because this goes back to what I said earlier about bonds being quasi-safe havens, because there is a risk, and the risk is the government. When you own gold, you don't have that risk. You don't rely on the government being solvent, whereas with bonds, you do depend on the government being solvent and being able to pay the interest payments. And so if that is the case, investors are going to prefer gold in this situation because there's simply less risk, but you still get the same benefit of safe havenness. So at this point, gold becomes the sole safe haven asset. When this occurs, when the real bond yields become 0 or below. Now, if real bond yields drop below 0 and go into negative, that's going to make gold prices even higher. Because in that situation, in this negative territory, not only you're losing money, you're really losing money, and in nominal terms it could be like 4, but in real terms it could be -2. That means in real terms you're losing money, right? So not only are you losing money, but you also have that extra risk of government not being able to pay its debt obligations, pay the interest payments for the bond. So at that point, that causes the demand for gold to increase, and increase in demand, increase in gold demand causes an increase in gold prices. So to conclude, basically there's a negative relationship between bonds, bond yields and gold,